Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. This is episode number 118. Now, as you can probably hear, I'm losing my voice a bit today, so I'm going to keep this intro really short. This episode is going to be a continuation of our previous chat with Brian Miller from Optimized Trading, which was back in episode number 109. And today we're going to cover a number of topics, including the application of game theory in trading, the model development process, the role of dynamic analysis, how to balance simplicity with complexity, also the impacts of price data evolution and some solutions, plus we have a few questions from listeners in there as well. So let's jump over to our chat now with Brian. Hi Brian, welcome and thanks again for joining us.
Hello Andrew, pleasure to be here again.
Yeah, it's great to have you back again. I think you're on the podcast maybe about a month ago or a little bit longer than that. So this is kind of part two of that conversation. We'll be talking about a couple of new topics as well and maybe expanding a little bit on some of the things that we covered in the past episode. So looking forward to that. But firstly, let's just do a quick little bit of a background on yourself just for people who may not have caught that first one. So can you give us a little bit of information on your trading background?
Sure, yeah. So I started trading in 2008 as a discretionary trader, quickly flipped over to discretionary and systematic. Started off with the FX, however, quickly went to index futures where I've pretty much stayed. So I primarily focus on drifted market types, systematically short to long-term swing, large cap stock, sector index ETFs, index bond, crude, gold futures.
Okay, thanks, Brian. Now, I just wanted to start our chat today talking about game theory, which is something that we were kind of talking a little bit offline. So, game theory is quite common in the HFT field. However, you mentioned that it doesn't just offer insights into HFT. So, I'd like to ask you a little bit about that. But first of all, perhaps we can start with the basics in what is game theory?
Right. Well, game theory is really, it's nothing more than a mathematical reflection of human behavior, and really has a lot of applications. Even though the current, strategists have found, a very specific application within HFT and scalp strategies. Really human behavior applies to all frequencies and all cycles. It's just a matter of, really what objective or what type of value that you're trying to exploit that meets your performance and risk objectives. So for us, really, like I said in the prior podcast, using the, philosophical views of game theory, not so much necessarily the mathematical equations from it, but really it's underlying concept that fuels or justifies some of the behavioral analysis that we apply to a specific type of stock, which provides the majority of our signals for most of the models that we apply within our multi-model systems for multiple asset classes.
Yeah. Okay. So can you perhaps give us an example of what type of thing are we looking at here? If we're trying to create algorithms that work off human behavior, what type of behaviors are we looking for?
Well, for us, being in the short-term to long-term swing type of frequency or cycle, we are wanting to look at the type of behaviors and justifications that support the concept that we're applying to a market. And again, that kind of reverts back to the R&D process. But really, we want to look at institutional behaviors, as I kind of touched on before, of the types of strategies or concepts or analysis methods that they may deploy, which enables them to identify what type of value are they seeking. When are they looking to rebalance portfolios? What reasons are they looking to rebalance portfolios? and really trying to apply a strategy that kind of mimics those. So their applied assets or their positions further fuels our market timing strategies.
Right, okay. But so you've just mentioned there about rebalancing portfolios, but how do you kind of get an understanding of what institutions could be doing without actually working for one?
When we're seeking to, identify what types of strategies institutions deploy, really, it comes down to, market timing concepts versus buy and hold. We tend to focus or lean more towards buy and hold behaviors because those influence the market in a greater capacity for a longer length of time, which gives the independent model that maybe we have developed for that condition a higher payoff matrix. So, for instance, an example of this would be companies typically rebalance their portfolios, as I touched on before. When they see overwhelming risk within the marketplace, they'll rebalance into, protectionism stocks, large cap blue chip companies. However, when they see more growth opportunity within the marketplace, they'll rebalance into growth stocks. Now, growth stocks kind of come in and out of favor a little more frequently. However, the protectionism strategy or stocks typically kind of never change, so to speak. So, we tend to focus our analysis on companies such as Walmart, a lot of consumer staples, consumer discretionary companies, Johnson & Johnson, Procter & Gamble, etc., to capture the behavioral signals of the buy and hold or rebalancing strategies deployed by institutions to really determine what type of model should be applied to the marketplace. And all of this can be done systematically.
Yeah. Okay. So when you're looking at those type of things, so for instance, in that case, you're looking at market conditions and then perhaps are you looking at volume and things like that to see if there's these type of footprints from large institutions in the market?
Yes, definitely. Fundamentals is also another one at play. Average cycles too, kind of on a larger cycle, more or less on years, zoomed out, a little farther. But market cycles, fundamental data, price and volume data. Obviously, we don't really look too deep at social data. That market's evolving a little too quickly for us. We prefer to wait a few more years before we start implementing social analytics. But I think that the more money that is behind the model that creates the condition for that model to produce consistent outcome, the better. So, we tend to focus more on buy and hold strategies more so than the institutions that may deploy market timing concepts.
Yeah. Okay, so if you're looking to model human behavior in the markets, is there any difference in the application of game theory on human traders compared to algorithms?
Sure, definitely. So obviously, human behavior, would be more emotional. Obviously, so emotions are less fact-based. So, for instance, a lot of these, if you look at the current market environment for the S&P, you'll see these short-term volatility spikes, which is majority news-driven. It's a very short-term negative news cycle, and so really these create fabulous buying opportunities. So, those are kind of the differences between, systematic is less emotional, it's more facts-based, while human behavior, in some respects, creates opportunity.
Okay, so for someone who wanted to look into the application of game theory further, what do you recommend they would do to get started there?
Sure. So primarily focus on some well-known, Nobel Prize-winning economists, mathematicians, cognitive scientists. A few behind is John Walsh, Lloyd Shapley, Newman. Let's see, Gerard Dubrow has a good on value. Behavioral would be Amos Tversky, Daniel Kahneman. Let me see. Kenneth Arrow and Herbert Simon. Those are a few of some of the works that I follow that will offer some good general concepts and philosophies to apply to maybe provide a few ideas and concepts regarding areas to exploit or look to try to identify multiple types of value, or justifications for a concept, because justifications for a concept is just as important to reduce is the many risks of failure associated with systematic and conceptual applications. You really want the concept to be justified in as many ways as possible, quantitatively or technically, fundamentally, and behaviorally.
Yeah. Okay. Well, let's dig into this concept development a little bit more. It's something that we kind of touched on a little bit. I think maybe towards the end of the last chat that we had, you made a statement about when heading into the development process to never go into it with your mind made up already about a concept, but rather let the R&D kind of guide you down a path. So can you explain a little bit further about what you mean by that and how you actually apply that when you're developing trading strategies or concepts?
Sure. So, it's very hard for a developer to not have a bias because, typically most of us have already developed a lot of successful strategies in the past. So we kind of go into every new project kind of thinking that we know what will work and what won't work. But, really, I prefer to always start, no matter what I may feel, is to start with, the research and development, the data, the price analysis of the asset that I'm trading. Really dive into the characteristics of the market, the cycles, the frequency strengths of that market, and then try to, is it more reverting characteristic or momentum? And then trying to mold a concept around the data that the R&D provides, and not necessarily, if I have for instance, a multiple frequency momentum strategy that seeks to identify, certain types of value on pullbacks, those types of strategies may not work very well on a very strong momentum market. So really, it's just matching the concept for the specific asset that you're attempting to develop a strategy for.
Yeah, I think as you mentioned there, the challenge is often you don't realize that you're doing that and that you're trying to mold this concept into a preconceived idea. So how do you actually catch yourself doing that?
It's from the very beginning. You have to create a guideline of the development process to kind of
Right.
in order to have that from the start. So for every new strategy, or if you're simply wanting, not necessarily a new strategy, but if you're wanting to implement another asset within your portfolio, instead of applying a concept that you already have from that, start from scratch. And so just really dive into the data revealed from R&D within, the data analysis, and just mold a concept from that from the very beginning. And then that way, that you're not applying any bias to that. Now, obviously, if it's a large cap and you have a lot of other successful large cap concepts or multi-model systems, then obviously you're going to have a decent understanding. But obviously, every market has subtle differences, and so you need to account for those. Not necessarily, not just really the momentum to reverting ratio or anything, but just the natural cycles or frequencies of that market can be vastly different in some cases. Also, the correlations.
Yeah. So in our previous chat, we discussed a little bit about dynamic analysis. So that can obviously help with letting the R&D guide you, right, in when you're developing concepts.
Sure. So, with dynamic analysis, there's a lot of ways to do it, or to apply it. With us in our concepts, again, we revert back to the data or the patterns that we extract from the R&D. And so, for instance, if you're developing a multi-frequency momentum strategy to identify certain variations of value, the three, small, medium, and large frequencies that you're kind of looking at momentum or measuring momentum, those links or look back periods don't have to be some set value. One, they don't have to be set if it's a GC model or a general condition model, for instance, they can be correlated or linked to or weighted from a combination of, the current cycle lengths or frequency strengths, versus the small cycle strength, the medium and large, so on. and also, what is that relative, what are those amounts or averages historically, and what have they been recently? And then you can even use some kind of weighting mechanism for adaptive there. If it's a CS model or a condition-specific model, you can also use a weighting mechanism, but they can be correlated to what that condition was historically. For instance, if you're only looking or developing a model for, if both small, medium, and large frequency momentum are both, drastically very strong, then you can only look at those conditions, historically, and use links or data extracted or patterns extracted from those very specific conditions, and use that and apply that as your look back link. So, I think that dynamic analysis has multiple applications, not simply within the analysis methods that you're using to extract the entry signals, but also within the plethora of exit models or strategies that I would highly recommend you to apply, with profitable exits and loss exits. Yes.
So you kind of just touched on there that you're looking for underlying models to be simple, but then by overlaying this dynamic analysis, it sounds like it could be adding some type of complexity as well. So how do you actually get a good balance between simplicity and complexity?
Right. Well, within the underlying strategic model, we prefer to deploy, quote unquote, creative simplicity, where, and John Conway talks a lot about simplicity and complexities, and how the more robust solution will always be simple solutions, which also reduce some risks of potential failure. But as long as the mechanism that is adding complexity is increasing the level of justification, for instance, yes, you may be implementing some dynamic calculation to determine your look back period or lengths or what have you, or some other value, but you're basing that, you're applying that so that it's justified on some type of market price justification and not simply an optimization result. So I think that within the complexity side of things, the individual model side, it's best to have creative but simple solutions. But there are benefits to more complex systematic structures or control modules that can deploy internal correlation and efficiency analysis, reactive and predictive processes, and decision trees. So there are many benefits to complexity, but especially within the machine learning. But one major flaw within machine learning is if you use it to develop the strategic model, you don't necessarily know why it's choosing that model. But if you use it within the control modules and to identify the optimal control or the optimal strategic model, then at least at minimum you can identify the underlying risks of that strategic model, because you know what that model is designed to exploit. So there are pros and cons of each, and both do have their place within a systematic structure.
Yeah, so if you're using these type of control models to look at perhaps the most recent performance of a model and switching back and forth between those, that kind of sounds a little bit like it's equity curve trading. So what's the difference between that and like a predictive analysis approach that you just mentioned?
Right. Well, you kind of have multiple levels there. Obviously, one, you can apply machine learning to that. The other is internal correlation and efficiency analysis. With us, it's identifying how, not necessarily, analyzing performance metrics is part of it, right? Because that tells us, how close is that solution to the marketplace currently, or what is it producing? But it doesn't tell you everything. For instance, if you have an entry price at F, right? Well, how much further, if it's some type of value strategy or reverting concept, well, how much further down does price continue to go before price then comes back up and validates the position? Or how long does it take before it validates? So there's a lot of ways to really measure the correlation strength to the current market environment, as well as being able to look at how models perform relative to each other, relative to different market environments, and not simply choosing a strategy because its equity curve is better than any other equity curve of the individual models that you have within it. But what is the projected market environment? For instance, we deploy two types of weighting mechanisms. One, we identify the current market environment and substructures. And then we also identify the projected market and substructure. Now, obviously, we're not always right with the projected market environment and substructure, but that can be weighted. For instance, that can weight the decision of how the control module will look at some of the independent models that you have within the control module. So you're not completely using predictive logic, nor are you completely reliant upon reactive logic. You're implementing elements of both, and so your strategy does need to deploy reliable predictive processes, as well as being able to quickly respond to sudden or drastic changes within the marketplace.
Okay. Well, that leads nicely actually into a question that we got here from Marco. It's quite a long question, so I won't read it word for word, but I will kind of give you the gist of it. So in the previous chat that we had, you explained how you can turn on systems or increase the size of the systems based on their best performance in the most recent period of time. And then you also mentioned that you gauge market conditions and, sometimes those can change pretty quickly. So Marco's question was around, by having these approaches, perhaps you're adding some complexity and perhaps you're increasing the chance of overfitting. So what do you say about using these type of approaches? How does that match in with overfitting or not?
Okay, so keeping the underlying models, creative but simple and justified, as I previously spoke about, is critical. You want the justification for that strategy to produce consistent outcome should be the robustness of the underlying strategies or the underlying models within your control module. The purpose of the multi-model systematic structure is not necessarily to increase the net return of a strategy, but instead focused on protecting against the risks of failure, of systematic failure, conceptual failure, price data evolution, correlation, obviously falling in and out of favor of the marketplace for any particular reason, but when you identify a model, you don't want to activate it merely based on its performance, nor do you want to activate a model simply because an optimization result has told you, yes, you should include this model, even if it's some type of generic concept. So I think that it speaks to what types of concepts you're implementing within your control module. And then also the techniques that you deploy within your control module, not simply using predictive logic and not simply using reactive logic by using some type of equity curve switching mechanism either.
So what are the impacts of price data evolution and how do you address those in model creation?
The biggest issue with over-optimization really comes back to price data evolution. And so with price data evolution, even if a solution has a solid strength for its identified condition, nothing will ever be as it was historically. So, one aspect of that would be to create or allow multiple entries to exploit that. And that will also allow you to diversify the factors that produce outcome by not simply choosing to exploit random variations of value or cyclical. So you can actually exploit both within a single concept, which is somewhat like a multi-strategy, a multi-model strategy, except that you're deploying it on a per model level. So I think that dynamic analysis, yes, it's good. Predictive analysis, that's all well. But really, it's all combating randomness and price data evolution. And how are you going to apply a solution to an ever-evolving problem? And to us, the most paramount solution resides within a multi-model structure, not being dependent upon any any individual strategy, no matter if it deploys dynamic analysis or not. And then the other would be not to be dependent upon a single entry, single exit. So you're actually allowing or giving it that strategy more opportunity to validate and to have a profitable outcome.
So if you look at this evolution of price, do you kind of let that drive the data that you use? Like, do you prefer to just work with the most recent data and not data from a long way back because the markets have changed since then? Does that factor into your development?
Sure. Yes and no. I think any data is good, right? The more data you have is good, especially not really for determining a concept, but at least for validation basis or Monte Carlo kind of simulation concept. But we don't typically go before or use data before the 1998 period. You saw a drastic shift in market characteristics during that time, and to be honest with you, I don't really suspect it will ever return to how it was before it, to where you could use a very simple strategy and really perform very well. So the markets are definitely have more characteristics of randomness within them, and so you have to be able to combat that.
Yeah. So I guess that probably means that these adaptive type of approaches are going to be even more important in the future as the markets continue to shift.
Yes, exactly. And actually, if you look at our current performance. If you look at for instance, the GC models that we include within our IMM control module, one way to kind of identify this is, if you develop a strategy and let's say you apply it, to 20 years of data, and you see a steady improvement of performance. That is a really good thing. So what you don't want to see is a steady decline in performance. You could still have a very good equity curve, but if year after year you see a subtle decrease in performance or solution strength, that's not the direction you need to be heading. What you want to see is that performance is steadily improving with every year, and basically what that means is really that the market's characteristics is evolving closer to your solution, providing higher correlation. So that's a good thing.
So you've mentioned a couple of different options for these control switching modules. You've talked about correlation, market conditions, recent performance, and a bunch of other things you mentioned there. So do you think that there is one particular approach that really can give you the most bang for buck?
Sure, definitely it's correlation analysis. And correlation analysis provides some fundamental justification as to why you're switching to a different model, as well as it will also provide some predictive patterns that we'll be able to extract from that, which could be applied within your weighting mechanism. So correlation analysis with models correlations to the marketplace relative to each other, relative to specific environments, as well as the capturing and analyzing performance metrics, not just simply on how much return it's generating, but how many trades it's producing, the accuracy, how far price was, the depths of price from the entry point, how long did it take to validate. So there's tons of different metrics that can be extracted that look way beyond simply net profit, so to speak. But definitely correlation analysis, and it will provide some. It may even lead to some independent concepts, some independent ideas for strategies down the line.
Okay, I just want to ask you one final question before we start wrapping up for today, and that was about the role of creativity. And you kind of touched on a little bit about stepping outside of the traditional views or human logic. But what can you tell us a bit more about that?
Well, the market really. Sometimes it's illogical, and we were just speaking about the level of randomness within the market is actually increasing. So what humans tend to think of as logical. Sometimes the market, have you ever developed a strategy and it couldn't produce a worse equity curve, right? Then you reverse it and actually, it's the best thing since sliced bread. So, a lot of times what seems to be logical isn't really what transpires within the marketplace. So I think that, within the R&D concept, don't limit yourself to these rules that others may tell you is a requirement for a successful strategy, such as, a high profit factor, or you'll hear this one, it has to have a Sharpe above 2. It really depends upon what your goal is, what your performance objectives are, and then obviously mold a concept around that and the characteristics of the market. But set stops and set profit targets or risk return ratio, all of that. Don't follow. It's very hard to get ahead following others, and so I think that the biggest lesson that you can take away from possibly this session would be to, kind of make it a point to detach all of those little rules and regulations that you've been following to develop a strategy and kind of just see where it takes you within the development process. And just, I think that's the one joy about our love for development, is that really your own limitations. You're only limited by your own personal level of creativity, and so follow that wherever the road may lead. And if you don't apply any limitations to that, you may be surprised in what it may reveal.
Yeah, okay. Usually we finish up with a couple of quick closing questions, but you've already done those in the previous episode, so I won't go through them again. However, you did, when I asked you about your favourite trading books, you said you don't really have any, but you obviously follow the work of other people based on our conversations we've had already. So do you want to share some of the people that you follow and the work that they've done?
Yeah, sure. So, again, reverting back to the trading books, I think that, being a mentor and having a mentor is crucial to, really taking that next step in multiple aspects of both trading and strategy development. It's very important to have one. It was critical for me and my personal growth. I need to say that. But as far as works and books regarding trading, I never really focused much on books about successful traders. It was more on philosophy, economists, mathematicians, cognitive science. And so you can actually just Google, Nobel Prize winning mathematicians or mathematician economists, and really just try to, scroll down until you find a few that you like, and kind of pursue some of their works. But, for me personally, it was, regarding complexity, John Horton Conway has a few published works. Game theory, obviously, it was Nash, Shapley, and Newman. Value would be Gerard Debreu. Behavioral would be Amos Tversky, Daniel Kahneman, Kenneth Arrow, and Herbert Simon were some of the works that I've definitely followed within the 8 years or so that I've been trading, or 9 years. But I think that again, I've read a few of the trading books, and a lot of times I think that there's more value in looking elsewhere for more on philosophy and conceptual kind of design and complexity and how to identify variations of value than really necessarily knowing how someone attained their level of success, because everyone's journey is a little bit different. No specific strategy for the same person can have the very same outcome. So, what kind of strategy or concept worked for someone else isn't necessarily going to work for them, because the world's changed since then. So, I really, find your own path, definitely.
Yeah, it's interesting you say that. I read a book. I've been trying to remember the name of it. I think it's like How to Get Ideas or How to Come Up with Ideas. And part of the framework that they teach is to actually look in different fields. And there's been a lot of times over history where someone's taken an approach from one field and brought it into another. And there's been breakthroughs and all kinds of great results from doing that. So I firmly believe in what you've just said about looking in other fields and seeing if you can apply some of those concepts to trading to find your own path and come up with something unique.
Yeah, the markets are very unique in that respect. They're a combination of of human behaviors, of obviously corporate growth, corporate goals, market cycles. I mean, there's so many dynamics at play to really consider. It's really fascinating, and how many different areas could you extract alpha from? So, really, like I said, you're only limited by your own level of creativity. So,
yeah. All right, thanks, Brian. Now, for people who want to find out more about you or from you, where can they go?
Yeah, they can catch me at my LinkedIn account, Brian Miller, or website at optimizedtrading.com. As far as our products and leasing, our products are available on iSystems trading platform as well as Striker and BTR futures. We will soon be launching on C2, and we're actually in the process of about to launch some signal services, which should be available within the next week or so. And our CTA will hopefully be operational on November the 1st. So that's our goal.
Wow, very busy.
Yes. A lot of irons in the fire, but really trying to keep the focus on what's important, and really, model development is my thing. So that's really where the majority of my efforts remain focused. Actually, as well, if your audience would contact me at my email, brian@optimizedtrading.com, if they're interested in leasing either the signal services or or leasing one of our products, we will offer a better system trader discount to your audience. And so another option would be we're thinking about offering an open sourced strategy as a one-time offer. We typically don't sell our open source code. However, this will just be kind of a guide for developers and how to create a multi-model strategy without deploying more complex systematic structures, such as internal correlation analysis or machine learning. So it'll kind of give a general guide of how to identify market regimes and to exploit them within a single system, and then you can develop multiple of those within the same strategy and deploy it. So that will soon be available on our website as well.
Okay, cool. All right, thanks, Brian. Sounds like you've got a lot to offer there, so I'll make sure to have links to your website and on the show notes page as well, so people can find those easily. All right, well, thanks for your time today, Brian. It was great chatting to you again. Is there anything else that you want to mention before we finish up?
Yeah, good luck on your never-ending journey of discovery.
Thank you very much, and good luck to you as well. So thanks for spending time with us today, and it was great chatting, and wish you all the best.
Good luck.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.